Hi, everyone. I'm Rick Bensignor, and welcome to this week's In the Know Trader Show. Well, after a big scare from a spiking oil market hit stocks yesterday, this morning's news that Saudi oil production should get back online faster than expected, we've seen oil dive as much as 6%, giving back more than half of what it rallied, and stocks have recovered to about unchanged on the day. Right now, I'd say the two biggest influences on the direction of stocks are the bond market and the oil market. In the No Trader clients know that I thought 10-year rates were likely to rise up to the 1.9 to 2.07% range from the recent low of 1.45, and we certainly got that. We hit 1.9, I think it was last Friday's close. To me, the move up tells me that investors that were overly concerned about a potential upcoming recession probably have a little less to worry about. I'm not saying it's off the table, but rates moving back up that quickly, about 45 basis points in, I guess, 2 weeks, is a huge signal here that things were overdone on the bullish side of the bond market. Then this week's oil shock has worried investors that growth could easily be affected by higher oil prices, and that's why we saw the sell-off yesterday. So at the beginning of September, for the first time this year, I really expressed to my institutional clients interest in the energy space, and I suggested to them that they look for names that were cheap in valuation terms. That's not something I can help you on because I don't do fundamentals. Near prior technical support, and then also stocks that showed downside exhaustion signals from either the sequential model or propulsion or something that kind of helped the idea that if we're against prior support, things would actually halt to the downside. So what I want to do today is go through the energy sector and figure out if it's bottomed, which I think it has. We'll look at the three key ETFs in the space, XLE, which is, of course, the broad energy space, which replicates the S&P 500 energy sector, the XOP, which is oil and gas names, and OIH, which are oil service names. And then we'll take a look at a bunch of individual stocks in those areas. So as we always do, we take a look at some other things first. I want to remind you that if you're in the Philadelphia area, on September 27th, I will be speaking at the Money Show there. Friday the 27th will be my time slot from 1:40 to 2:30 in the afternoon. It's part of their Advisors Money Show. So it's a separate track for those who are financial advisors, and I'll be talking about incorporating behavioral finance into the wealth management practice for financial advisors. You can earn up to 5 CFP credits if you take this track. So there's more information if you go to moneyshow.com. And getting to the markets, again, we always compare this week's look at the 11 sectors of the market versus how they were 2 weeks ago. And I've shown here with a red dot in the current week, the ones that have moved 1% or more in relative performance terms to the S&P since last week. So you can't necessarily look at the scalings off on these, so they don't always line up. But for instance, on the far right side, real estate is up just about 11%. It had been up 13.5%, so it came off hard in the past week. You can see that financials were down 1.49 last week. They're now virtually flat on the year versus the S&P. So with interest rates having moved back up, financials got a good bid. Staples were up 4.37. They're only up 1.88 versus the S&P now. So you're seeing some significant profit taking in the defensive side of the market, which we saw in real estate, which we'll see in Staples. We'll look where else. Energy, the big gainer here, it took in about 4.5 full percentage points of what had been underperformance. It's still underperforming, but now it's much better than it had been. Materials also got bid for, so they're still underperforming, but not as badly. And industrials picked up against the S&P, up about 4.25% over how the S&P has done versus 215 last week. And then also consumer discretionary names have come off with some profit taking of looks like about 2.25% or so. So that's how the sectors look. I want to remind you that the best way to contact me is Rick at InTheKnowTrader.com. I get lots of emails each week from those of you who listen to our show, whether it's on StockCharts or then, of course, StockCharts posts it to YouTube. So whether you're listening to it live on rebroadcasts or through YouTube, we get lots of responses. So Rick at InTheKnowTrader.com is how you can reach me. And of course, check out our website, InTheKnowTrader.com. We've got lots of videos on models we use, interviews I've done on TV, and things that are kind of really relevant to the type way we look at markets. So now let's switch to actual charts. And we always start off with the S&P just to make sure you have a sense of what I'm thinking for the overall market. So we've highlighted here the August decline in the trading range back and forth that broke out in early September. We just about 4 or 5 days ago posted a setup 9 count. Again, for those of you who might be tuning in for the first time, that's part of a Tom DeMark sequential model. It's the first phase of it. It means that for 9 consecutive price bars, in this case it's a daily chart, you've had the close above the close from 4 bars earlier. That's often a near-term turnaround point, but not the ultimate signal. The ultimate signals are the 13 counts, and you'll see that just shy of all-time highs in July, we had a 13 count, which is ups in this case. When the numbers come on top of price bars, it's looking for upside exhaustion. And so we got to 3,028 in the end of July. We, at that point, cautioned clients about doing any buying, suggested a pullback was imminent. We saw that. And now, again, a couple days ago, we got another 9 count suggesting that, to me, we took half of the tactical longs off for institutional traders simply because this 9 count took place underneath what had been all-time highs. I don't expect any major sell-off. And in fact, we may not sell off much at all. If we push through 3,064, we'll put it back on for a move that projects about 31.25 or so next. So I still generally like the market. Obviously, the oil scare that we've seen has brought some selling in, but the fact that today oil is still down over 3% as we speak, I'm sorry, $3 as we speak, it's 5%. Gives us some relief, and you can see buyers have at least stepped in and stemmed the decline. Also affecting stocks, as I said earlier, were interest rates. They're trading at about 1.8% right now, down from 1.9% last Friday, but still well off the lows. And I'd say the mid 1.6s to about 1.7 or so should be support at this point in yield terms. All right, here's the XLE. All right, so this is the energy sector in a broad sense. Why we use the models we do is because it's what institutions use, or at least many of them, and this sequential model can often give you a pretty good clue of when trends are changing. If again, these numbers come underneath price bars, it's looking for downside exhaustion. Above price bars, looking for upside exhaustion. So for instance, this is a weekly chart, so just 2 weeks or so before the all-time high in 2014, this is suggesting upside exhaustion. Down here, downside exhaustion, again, just a week or two before the end of the down move. Upside exhaustion on the top of the move, literally to the week. Downside exhaustion here in the middle of 2017, and we saw downside exhaustion again a few weeks ago. It also hit the propulsion exhaustion level, and that's why I was telling institutional clients to get interested and start looking at names effective essentially the first week of September. So we were able to take advantage of this up move. You'll notice that even in XLE terms, this week's high is against the first propulsion target. On the upside, those are the kind of bright teal colored lines. The green lines are full exhaustion levels to the upside. So again, this is why we kind of like things here in the XLE and we're willing to probe. Notice that you have higher lows here in MACD terms, and that's a lot of why I'm willing to look at energy names really for the first time all year. Let's look at the XOP, see how similar this looks. Let's take out, there we go. So similar type feel here in the sense that we've tested down to 2009 lows. We went beneath it, but have come right back to it. So this is, I won't say it's at a major inflection point because I don't see a lot of downside left. So I'm more apt to think that well, here, look, if we take the absolute lows to the move, let's put up a trend line. And we take away this trend line, which was really left over from the prior chart. So here, if we actually take a look at the lows, all we did this year was slightly extend beyond the lows from 08 and 18 and also 16. So the fact that we've come right back, and I like the energy space, makes me think XOP is also something that has room to go. So oil and gas names look decent to me from the broad ETF point of view. Here's OIH. So this is a weaker chart. We more definitively have broken underneath those older lows. We're doing a turnaround here, but they're not as strong. So I'd say technically OIH is the weaker between XOP and OIH. But generally, I'll stick with the same idea that these names have been beaten down for years. The XLE has underperformed the S&P for 8 of the last 10 years, and this will be another year, so it'll probably be 9 of the last 11. And, you know, it's kind of been a horrible place to invest, certainly in relative terms, which means that you could have invested in any other sector of the market and done better than investing in energy names. So it doesn't mean you didn't make any money in the energy space, but you could have made more money virtually anywhere else for the last 10 years. But I'm starting to get some signs that energy is finding bidders, and many of the names are cheap in valuation terms. Again, I don't do the valuation, but I know from talking to people who do that it's a very cheap sector. So find the right names, and there's opportunity here coming up. All right, so now let's take a look at some individual names. And the first we'll look at is Schlumberger, SLB. And you'll notice that this has been in essentially a massive trading range for the last 10 years. Roughly equal highs near 115, and somewhere in the mid to low 30s is what we think the bottom is. And again, given the sequential signal here, in the middle of 2019, we moved up, we made new lows, and we're back above it. Still makes me think that this has room. It's currently trading at 38.09. I'd say you at least have room up to 45. And if you really have a more significant bottom in here, 59 over time are upside targets. So I like the name. Halliburton, HAL. So this has not gotten as low as its 2008 bottom. Does have a sequential 13 in here from the middle of the year, just like Schlumberger rallied from there, broke down, but has come right back up. Again, I would kind of look at this as having upside maybe up to 32 and change from 21. That's a 50% move. So to me, it's worth, especially if you get chances for weakness, which for instance, you got today, because of oil giving back $3. There's a little gap in here this week from last week. I kind of don't mind anywhere from 21, or let's say current price 21.25 down to about 19.75. I'd be a buyer for move over time that gets you 32. So also good possibilities there. In the integrated oil space, and these are kind of the big names that you know of and think about when you think about gas. So we'll look at Exxon, kind of the granddaddy of them all. Let me try to get rid of this trend line. There we go. All right, so we've got a pretty solid downtrend line from the highs, and we basically have here a descending triangle, right? So we have equal lows going back to 2011. This is going to track oil more than some of the other names because obviously this is the core business of the integrated oil names. So it's like Exxon, Chevron, Oxy. So we'll look at them. This is kind of middle in between the downtrend line and the horizontal base here. So there's not much of a VIG to this. And I'm still, to me, oil, last October, I called the high in oil. We said it wasn't going to take out the $77 price that was made in, I think it was October of last year, was going to stay both as a cyclical high and very possibly a secular high. Now, exogenous events like bombings of Saudi oil fields is not part of the equation. But even so, I think you would really have to get through that high from last year, which is, let's see, is this in here? Oh, no. That's Exxon. Sorry, it's not oil. Anyway, oil would have to get above 77 or so, maybe even $80 to make me think that it's really materially going to affect the stock market. Otherwise, I still think oil's in a large trading range, and I don't think, other than these near-term pressures because of the bombing, that oil has good long-term fundamentals. So this name, I see no VIG or particular reason right now to be a buyer of the name. Let's look at Chevron, see if we get a different picture here. It is actually a significantly different picture than what Exxon had. Exxon had the long multi-year downtrend line. This is actually just more of a uptrend that we can see over time. So here we kind of have equal highs. Let's get rid of this line in the middle. We have equal highs at all-time highs and ascending lows. So an ascending triangle, if this breaks out to the upside, then this ultimately says it can get to 164. So I'm a little more partial to this name. Again, I'd be a buyer on weakness. I wouldn't be concerned until this broke under 110. So when you look also at a $124 stock, let's say even from current price, you have a little more than 10% on the downside, but you have three or four times that on the upside. So this is a name that certainly I would favor Chevron over Exxon. If I was going to choose between the two. The other one I kind of put in this group is Oxy Petroleum. Clearly a much weaker name. In fact, the worst of the three that we just looked at. Let me get rid of some of these lines. And so here the question is this worth bottom fishing? And if we go back to lows in 08, were kind of, the lows that we saw a couple of weeks ago held against there. So if this name is cheap in valuation terms, which I suspect it is, where at least you do have a chance for a double bottom here, longer term. I'd say Chevron is kind of the better one of the three, but if there's one that's going to play catch up, it's Oxy. So at least here you're buying much cheaper in price terms relative to where it's traded over the past several years. So this is a name, again, in the space I would consider. Let's take a look at some of the oil and gas exploration names. So ConocoPhillips has been trading in a range. I'm just trying to remove this line. There we go. All right, so there is a downside buy. There is a long-term downtrend line that has three specific touches to it. There is this bigger double bottom that we saw from 2009 and 2016. Importantly, I would say, is that recently on the low, You had the 13, same way this bottom was picked here. Now it's gapped up. It stopped right at the propulsion level. This is type name that if you're interested in, you buy on a pullback on the gap that got created. So anywhere, I'd say closer to last week's high, if we can, fill in some of the gap from the Saudi bombing news, you get a chance here to buy this maybe 10% lower than it is now. So, but it's a name I consider, more so because it bottomed on a 13. The bigger picture is, again, you're somewhat in the middle of the large range it's seen over 10 years. There's not a huge vig here, but it fits into, again, the sense that there's a decent chance that energy names have bottomed for the near term. So certainly one to consider. EOG. All right, so here's the chart of EOG resources, same ticker, EOG. So look, long-term uptrend line. It's not perfect, but it's darn close. So the lows that we saw recently are along the major uptrend. We've bounced from there. Again, I kind of like the idea that there's almost every one of the charts we've looked at, we've been able to find a reason to be bullish. Now, because I'm bullish the group, I'm going to be looking for reasons to be bullish, but I'm not going to disregard reasons to be bearish, so that I don't want to be so swayed by my own bias about the group that I just simply choose to look at charts bullishly. So I still also want to point out to you anything that we see bearishly. In this case, you still have a fairly sharp downtrend line that we stopped against pretty much at the high this week. So this has not resolved itself yet. So I have less inclination. There's no exhaustion signals here on the downside, no 9 counts, no 13 counts, no propulsion level. That was where the low was made. The low was made essentially by the trend line. So for me, I probably have to see this break above 90-ish, break out to the upside to then think that we can get up to 109 over time. So this name, I'm definitely more neutral on at the current place. And if it broke down and took out the low from a couple of weeks ago, then you're kind of more in trouble too, because there's nowhere. I have no counts. I have nothing to suggest that you've got bottom. So of the bulk of the names I've looked at, this one I'd say I'm probably least favored to just going after, simply because of the bigger picture and the fact that other than the trend line, I really just don't have much to think that the low is the low. Let's look at APC and Adarco. Oh wait, APC is no longer. Let's do PXD, Pioneer Natural Resources. All right, and again, we'll take away these lines and take a look at what we've got. So the recent low has similarly no particular downside exhaustion. It's not at a propulsion level. There's no 9s or 13s. It's somewhat similar to what these lows have been. You still have a downturn from all-time highs. And you have this downtrend line here too. So a little more mixed. I do like that MACD is closer to crossing into a positive signal. So far, we've failed to break through the propulsion level correctly. So here's what, well, it's unlikely going to happen, but in subsequent weeks, you'd look for a Friday close that's less than the Friday close from the week before. In this case, you'd have to close under 135.43 this week. So you'd still have to sell off another $4 between today and Friday's close to get that. If that occurs, and then next week, next Friday, we close above 142.26, and the following Monday gaps higher, and sometime that week trades above next week's high, then you get a propulsion signal to the upside that says 169 and change is the next target. So it's just about 170. Otherwise, this is one of the names that I kind of a little more inclined to lay off of. If you're a pure trader, you buy a pullback, you'd have to risk down to recent lows though. So the risk reward is barely a 2-to-1 if you get that. But if we can get the propulsion signal kicking in over the next couple of weeks, then I become more friendly towards this. Phillips 66 PSX. So again, let me just get rid of some of these trend lines. Funny how the charts carry them over the way they do. So this certainly, look at the up moves, going back to 17, early 18. 13 sell signal here, upside exhaustion. Huge 2-3 week decline. 13 here, a little early, pulls back. 13 on the all-time highs, pulls back. And then you get the recent low now, or actually this was the mid-year low. So notice that there was a set of 9 counts here on this year's low, which matched the lows from Christmas time. That would have been a signal. I didn't see the stock at the time, but if I had, that would have been a buying opportunity to me. I'd probably risk a couple of Friday closes underneath this propulsion exhaustion level to play for the up move. We've now gotten a 9 count to the upside that stopped right against the propulsion level. It stopped against, now notice this propulsion level's been in place since Christmas of last year. So it did say that if we get through 91 properly, which we did, the stock would get to 104, which is exactly what we've done now. So what we want to see is further moves through this level, a couple of Friday closes there, which ultimately would then say new all-time highs. So this is definitely one of the better names in the sense that, well, let me make sure I'm not misspeaking about all-time. Yeah, that is all-time highs from 2018. So this is actually one of the better stocks. If we can break through this 105, 104 and a half-ish level properly over the next couple of weeks, it would suggest that over time, this could get up to 130. A pullback to around 93 and a half, 93 and 3/4. If it came, I'd probably welcome it as a buying opportunity. At that point, if you did that, you'd have to risk almost $10. So that's almost 10%. But then at 93 to target 130, you've got about a 3.5 to 4-to-1 upside risk to reward ratio. All right, we've got one more before we finish up. Let's look at Valero, VLO. So Valero just missed getting a 13 count. It got to a 12 and moved higher. This name kind of been in a trading range for most of 2019. Same type thing here. I want to see a fresh propulsion buy signal above 88, 84. If we can get that over the next few weeks, then you buy it and you target about 109. So by and large, I like most of these energy names. There's a few I don't, but if you listen to this, you know which ones I prefer over others. So that's it for this week. Thank you for tuning in and listening to In the Know Trader. We'll be back again next week. Bye-bye.